Meantime, it's time for the Word on Wall Street. A look at what top market experts are watching this morning as we kick off the week. Joining me now, ER Shares CEO Joel Schulman and Bulltick Capital Markets Head of Research, Kathryn Rooney Vera. Kathryn, let's go ahead and start with you because Cheryl highlighted the key speakers at the DNC kicking off today. A lot of star power there, if you will. I'm wondering what you think the markets are going to think about the conventions kicking off virtually, how different it's going to be. You've got a Biden-Harris ticket right now. The Wall Street Journal is saying, you know, traders are bracing for a lot of volatility as we head into this election period.
Well, the market now is more than a quarter attached to 5 stocks. So those 5 stocks, which are principally technology stocks, I think are where the market is going to have its laser-like focus, Jackie. And that is with regard to the potential for antitrust, onerous regulatory burden that could come, and that could be in the fore under a Biden-Harris administration. One of the things I'm looking for is who will be Treasury Secretary, and my bet is that it will be Elizabeth Warren. If that's the case, the markets will not like that, especially the banking sector, as well as in the healthcare sector. So these are things that I think the market is keenly interested in, especially with regard to tax imposition. So the stocks that have moved the S&P to these lofty levels are vulnerable under the next administration.
Kathryn, now that Harris is officially on the ticket, you look at these markets not really reacting much, kind of continuing on with the recovery after, you know, as we're dealing with the coronavirus pandemic, not really reacting to the choice there. And I'm wondering if you think that, you know, how long it takes before the markets start to look at some of the policies coming from the Democratic ticket saying this can really have an impact here because these numbers are not reflecting that.
Well, the markets are remarkably resilient, Jackie. And one thing I'll tell you as a strategist and as a market economist myself is that you have to deal with the combination of both what fundamentals tell you and what how the scene can change over the course of the next year, and a massive backstop by a price-insensitive buyer, which is the Federal Reserve. So if we get a drop in the markets, that's a big if under the next administration, once we get these policy moves and the market's internalization of how detrimental they can effectively be for small businesses and big businesses alike. We have to deal with the Fed. So at what point does the Fed then decide that too much is too much of a sell-off? It's already engaged in the purchase of high-yield bonds. What's to deter the Fed from moving from high-yield bonds into U.S. equities?
Well, it's a good point, but I also want to sort of focus in and look at the futures this morning because we've got a slight gain on our hands as we're getting ready for the trading session. Investors are eyeing retail earnings set for this week. We've got Walmart, we've got Home Depot, Target, other big names all reporting their results. This is coming after July retail spending numbers showed that American shopping rose higher than pre-pandemic levels. So, Joel, I'm wondering what you think. You know, the bar was lowered for these retail companies. The numbers aren't necessarily going to be great, but the good news is that the consumer is back out there, and that's really what is going to drive this recovery going forward.
Right. Well, as your viewers know, I mean, we're at record levels across the board. The S&P is still, you know, it hasn't broken through, but we're seeing a lot of movement, not only in the U.S. markets in small cap. They went up about 10.5% last month, but we're seeing a lot of money moving offshore now. $2.9 billion moved last week. That follows $2 billion the prior week and $2 billion the week before that. So we're seeing a big movement to offshore, 2.5% or 2.47% up last week in the non-U.S. markets in the EFA. And the non-U.S. small caps were especially bullish on those. They were up almost 9% last month, just a little bit behind the U.S. small caps. So we believe U.S. small caps and we believe non-U.S., particularly non-U.S. small caps, will really be strong. And we see this news continuing to push through to probably till November.
So if you had new capital to put to work and you're looking at this market and you know technology has been on fire, you know, is that necessarily where you'd go? The non-U.S. stocks, the small cap stocks, the journal writing that the cyclicals are starting to take off, and that shows sort of the breadth of the rally taking place here, which is important when you really think of a recovery in the scheme of things.
Right. We've seen this before, by the way. We've seen cyclicals, you know, have a run. People thought it was going to go from growth to value. It lasted for about a week, and then it went right back. So we realized that last week was a strong week for the cyclicals, but we've seen this before. I believe some of the tech long-term are still a good play for investors. And we really see, I mean, we're seeing flows, you know, in a big way going offshore and particularly non-U.S. small cap. That's where we would put our money. Small cap U.S. and non-U.S., particularly non-U.S. small cap offshore.
All right. Well, it is those small caps. It is the industrials. We saw them surging in so far this August. The Wall Street Journal saying that the investors are seeing this, as the breadth that I mentioned, that the range is widening after months of dominance by those big tech companies, Amazon, Google, Facebook, the like. Joining us is Washington Crossing Advisors market strategist and portfolio manager, Kevin Caron. Kevin, great to see you. I want to get your take on the markets as investors are sort of setting up for this Monday. So much going on. We're watching the coronavirus, the recovery, vaccines. We're watching the DNC kicking off tonight. What's the most important thing, and where would you be allocating capital?
Well, the most important thing is that the market sentiment and the good feeling that the market has been enjoying the last couple of months continues and begins to spill over into real economic data. So since March, we've seen a tremendous importing of stimulus money into the economy, just about exactly offsetting the decline in nominal GDP that we've seen in the private sector. But then beyond that, we've also seen tremendous support by central banks, and we're getting additional support globally by the Bank of China, for example. So this has been very nice. It's been good to see investors hold in there with reasonably decent levels of confidence funded by cheap money. But this now has to accelerate to the broader economy, where we would expect to see leadership broaden out away from groups like technology and really some safe assets like gold and long-term treasury bonds, for example, have simultaneously rallied along with technology, which is kind of an interesting trade. But that trade has to break one way or the other. Either things truly get better, or those insurance assets like gold and treasuries are going to become more desirable for market participants.
All right, Joel Schulman, Kathryn Rooney Vera, Kevin Caron, thank you so much, guys.